business owners. So it's not just going to be for individuals. It could also be for business owners. So I'm just going to quickly explain about each one of these groups. Individual and families, most of the time, we all have a permanent insurance need. But we want more than that. We want to have some cash value as well that will give us the flexibility because our lives are going to be evolving and we want to have that flexibility in the future for the just in case situations. We also have different riders and additional benefits that we can add, completely optional. And depending on the client's need, this can be a great way to complete the coverage for them and enhance their protection. Wealthy professionals, this is a really great solution for them as well. Most of the time, everything that we have in Canada, they're taxed, unfortunately. And we want to find different ways to minimize taxation as much as possible so we can have more that goes to our loved ones, as that's our hard-earned money. We want something that will give us liquidity. Like I said, having that flexibility for the future, whether that's for your retirement or long-term care. And I do know we have different savings account out there. For example, I mentioned retirement. We have an RSP product that's available at iA Financial Group, but we only have a certain amount that we can put inside that account and keep it tax-free. So for the type of clientele who may have maximized those type of account, we can also use Universal Life to have that additional liquidity in and really to just protect the long-term estate value of the client. Pre-retirees, if they're looking for a way to transfer their wealth to the next generation, or maybe again to supplement their retirement income, maybe they have maxed out their RSP, then even their TFSAs, that could be a great way to save as well. But like I said, it's still a permanent life insurance. We just have the savings component that's available. So that's just the feature that's available within the product. For business owners, the first thing that I want to mention about this is it is not a different product. We get questioned a lot about whether we have a permanent life insurance for corporation, and people tend to call that a corporate UL, for example. We do have it, but it's not a different product. I know when we say corporate UL, it sounds like something completely new and it can get intimidating because there's a lot of complex terminologies that are being used when it comes to corporate life insurance. However, if this can help, please note that we are using the same exact product. So everything that I'm going to talk about today, the same features apply to what we call corporate UL as well. The only difference will be we're going to change the applicant. Instead of having it as an individual, let's say Mr. John Smith is the insured. Usually for an individual plan, Mr. John Smith is also going to be the applicant most of the time. But if you want to have it corporately owned, then in this case, we just need to design the plan to make Mr. John Smith as the insured, and the corporation is going to be the applicant, beneficiary, and the payer. That's the only difference. And it is still a way to maximize the CDA, capital dividend account, which is pretty much going to be added to the client's beneficiaries given to them. It's going to be added to the client's net estate value, and really to minimize taxation as much as possible. And having the same features of the Universal Life, because like I said, it's the same product, it gives the client some flexibility as well to have an additional source of liquidity. And also that security. I talk a lot about flexibility when I talk about Universal Life. That's because that is, I would say, the main feature of this product. We have the savings component. That savings component is the main reason why this will be flexible, but also in terms of options that you can choose from, in terms of the premium, how would you like to pay them, and for how long do you want to pay them? It's so easy to adjust it to the client's life events, make something really tailored to their needs. And it's not just based on their needs, it could also be based on their preferences, it could be based on their budget. What type of investor is your client, their risk profile. And you can easily choose from multiple options to design the perfect plan for your client. We do have that savings component that will give you high accumulation. Like I said, this is a permanent life insurance. So this is something that's been designed for the client to accumulate in the long term. There is something on the screen that talks about a 0.75% bonus that's going to be given to a client. It will be applied to any in-force universal life plan starting in year one, and that can provide a faster accumulation. And I know when I say 0.75%, it does sound like a very small percentage, but again, this is long term. It's for long term. So eventually, that 0.75% bonus, it's gonna make a huge difference in the accumulation fund. That accumulation fund also has so many funds that you can choose from. When we talk about savings, we're talking about funds that you can choose from because that's how we're going to get the performance, the return that you can have. If the client doesn't want to deal with those type of account, because I understand some accounts out there can be very volatile. We don't know how the market is going to perform in the future. They want to have some sort of peace of mind. We do have an account that's called Smooth Return Diversified. It's the SRDA account that can give them some guaranteed feature where every year the return is going to be guaranteed. So for this year, it's at 3.85%. Next year, I don't know how much that could be. But the only thing that I can mention as well regarding SRDA is that it will never go below zero and it will never go above 8.5%. When there is a minimum return, there's also a maximum return. So between 0 to 8.5% every year, you know exactly how what's going to be the interest, the return for this one. For this year, again, it's at 3.85%. And I'm just going to try to monitor the Q&A as well here. Clients who are business owners, what coverage would I recommend? Have both UL for the client and UL business insurance. So this really depends. There are multiple situations where I have seen that the client will have both coverages. It's not the same type of coverage. One is more for the business, the other one is more for personal. And I think depending on the client situation, if the client has a family, they have or mortgage or different type of liabilities, they might need that personal life insurance. And if they have a business, they want to also have that corporately owned insurance. So it could be both. I've seen many situations where the client has both. All right. Let's get back to the slides. Strong overall competitivity. So this is not just for long term, because I talk a lot about the fact that this is a long-term product. So it could also be for short-term, mid-term accumulation. And we made sure that our product is designed for that. We do have a complete offer. Like I said, with Universal Life, you have multiple features that you can choose from, different options. And that's because we understand that everyone is different. Everyone has a different situation. Everyone has a different goal. Everyone has a different budget, different preference. And we want to give you the ability to design it based on all different type of clientele, based on their risk profile. So the one way to customize it is the features of the product. The other way to customize it is the rider and additional benefits that we have available. We don't have any policy fees on UL. I've seen some people still thinking that we do have policy fees on that. That's because I understand on different products, we do have them still, such as on a traditional life insurance plan, for example. But with Universal Life, we have removed our policy fees since 2016. October 2016, there was no more policy fees on Universal Life. So even if you decide to add, I don't know, let's say 7 riders to your Universal Life, and Universal Life, because it's going to be the base coverage, If the base coverage doesn't have any policy fee, that means that you don't have to pay any policy fee on any of those riders that you decide to add to the plan. So it can really help the client not only to customize their plan and complete the plan for them, but also to save on those different costs. As if you decide to take those riders, the solutions, those benefits as a separate policy, chances are the client might need to have to pay those policy fees. As an example, Universal Life with a term rider, with a term CI. If the client decides to get them separately, Universal Life separately, UL doesn't have a policy fee. Term, that's still traditional insurance, and that one has a policy fee. They want to take CI separately as well. CI does have policy fees. So in most cases, they have to pay 2 policy fees if they take all the coverages separately. But if they want to do it under one product and the base coverage doesn't have policy fee, and they have no policy fee on that plan. We do have investment guaranteed on death. We also have 3 death benefit options. So when it comes to protection, life insurance, we want to focus on protecting the family and answering their insurance need. The main ones are face amount only and face amount plus fund. The third one that we have is not so much about the protection, it's more about the accumulation fund. That one is the face amount plus fund with wealth maximizer, and that's a completely different type of clientele as well as type of training. We also have different cost of insurance available. So I'll talk more about these ones after, but just to give you an idea of what they are, it's level cost of insurance and warranty cost of insurance. And there's also another one that we call level with guaranteed quick paid option. Again, I'll talk about this one shortly. And by shortly, I think this is exactly the part where I'm going to talk about them. There you go. Okay, so let's start with the main, not the main one, sorry, the most popular one. And there is a reason for that. Universal Life with warranty cost, from what I've noticed, has been the most talked about. Is it one that I will recommend? Maybe not all the time. So it's really hard to say exactly what is the best plan for everyone. What is the best plan that we have? We always get asked about that as well. However, that's a question that I would never easily answer. That's because everybody is different. We're all different. Warranty cost type of insurance, that's a great way to accumulate in the beginning, as long as you understand overfunding. It's, I would say, something for a moderate risk profile type of clientele, for a client that likes liquidity, but that liquidity, they wouldn't get it if they don't overfund their policy. So that's why I say this is for a client that understand overfunding, understand Universal Life, based on the client's age. When they're younger, usually that's when the cost of insurance is going to be lower. So I think this little graph right here on the left-hand side is going to tell you exactly how this works. The warranty cost type of insurance, that stands for yearly renewable term. When the cost of insurance renews, it's based on the client's age, and because we're all getting older, that cost of insurance most likely is going to go higher. So that means that in the beginning, we're going to have a much lower cost of insurance. And in the beginning, that's the time to overfund the policy as much as you can, because that will help you cover the future cost of insurance when those costs of insurance are going to go higher. Your premium that you're paying, it doesn't mean that that's going to be enough to pay the future cost of insurance. So that's why having that additional cash value saved up can help you pay those costs of insurance in the future. So when we get asked about what's the best plan, it's really hard to answer that question because there are so many factors inside UL that can affect the entire result. And by result, I'm not just talking about the premium. I'm also talking about the result in terms of cash value? Can we keep the policy in force for life? Like I said, it's a permanent life insurance. So there are so many factors that can affect a universal life plan, and it's never a short answer when we get asked about what's the best plan when it comes to UL, because everyone is different. And even the projection that you're using can affect the entire result. And by projection, I'm talking about, let's say, the interest rate that you're using. 1% difference can make a big difference. So that's why we just need to make sure that we understand the cost of insurance that we're paying today is not going to be the same next year and in the future. So as long as we understand that and the importance of overfunding, sure, this could be a great solution for a client. And most of the time, the reason why people would take this is because of the low cost of insurance in the beginning, but they have to also understand that that cost of insurance is going to be higher in the future. So we just need to be very careful with that. We do have another question, why the surrender charge period is so long, 15 years. So that is a change that's been done recently. It was a change that was designed based on the product, how it's being used. And we just want to make sure that we have a policy that can that it's being used the way it's supposed to be used for, as in it's a permanent life insurance. And especially for YRT, we don't want the client to surrender that in 2 years, for example, because it's not going to be beneficial for them that way. And then we have different features in here. Something that it's never mentioned, not never, sorry, that we don't always talk about is the fact that YRT cost of insurance is actually paid up at age 90. I know I said it's a permanent life insurance, but paid up at age 90 means that at age 90, all cost of insurance stops. Even if the clients survive at age 100, they still have the life insurance product in force for them. They're still covered. They're covered permanently. They just have an insurance that's going to be paid at age 90. Doesn't mean that we cannot quick pay it. We can definitely quick pay it. And that's where I talk about the flexibility of the premium payment. The premium payment can be customized, but the cost of insurance, they do not stop until age 90, only for YRT cost of insurance. And the reason why I say that is because we do have a different period for level cost. I've talked about these ones already, the fact that we have accumulation fund, and that investment account will give you an investment bonus of 0.75% as well. We have full flexibility because of the cash value, and that is also accessible. Now, level cost of insurance. For a different type of clientele, not so much those who want to take that moderate risk. For a type of clientele that want more peace of mind. And I'm not saying that YRT is not going to give you any peace of mind. We just need to understand how the policy works, how the product works, and understand the importance of overfunding. But level cost of insurance is a little bit different. These cost of insurance will be the same from the beginning until the end. So I would say for a client with a more prudent risk profile, and then in the beginning, the cost of insurance might seem higher if you compare it with YRT cost, but at least the cost of insurance does not go up or go down. It stays the same. So if your client wants to know exactly how much they should be paying, how much they are paying today, and they want to have the peace of mind that that's never going to increase or decrease, of course, unless you make a change to your policy. If they want to have that peace of mind, level cost of insurance might be good for them. For this one, we don't have any surrender charge. And it's paid up at age 100. Now, that's very different for YRT cost of insurance. Paid up at age 100. I have different questions in the chat that seems to be more like a case. For these ones, I would recommend that you reach out to me after the training. There are so much longer questions that's probably going to be longer to address, so better to address them after the training. All right, so like I said, paid up insurance, this is paid at age 100. And then the cost of insurance, although they're paid at age 100, you can still pay them quicker. But when you pay them quicker, it's going to depend on the market, on your accumulation fund, how those funds are going to be performing. If you don't want something that's going to be depending on the market, you might want to consider the guaranteed quick pay option. We have 3 options available: 10 years, 15 years, and 20-year pay. So that's available only with level cost of insurance. Level cost, again, if you just want to do regular level cost, that's going to be paid at age 100. If you want the guaranteed quick pay option, we have paid up in 10 years, paid up in 15 years, or paid up in 20 years available. They're definitely going to be more expensive, but if the client wants that additional peace of mind, this can be a great option to have. And I would say even for children. This is exactly what I was explaining. So this is a very unique feature, I would say, to IE. Not only you have the guaranteed features that a lot of people are looking for, but you also have the flexibility of a universal life that we already have. So you get the best of both worlds. It's only available with level cost of insurance. Like I said, I'll explain more about it after on the illustration, as I'm going to explain that on a demo, which I think is going to be much easier to explain at that time. But we do have those available. In terms of death benefit, the death benefit is what are we going to give to the beneficiaries upon death. That's why it's called death benefit. And something that I forgot to mention is that with universal life is very, very, very important to differentiate cost of insurance versus premium and death benefit versus face amount. These are very different. So if I just go back to the cost of insurance quickly, the cost of insurance is what needs to be paid to keep the policy in force. The premium is what you're deciding to pay. Death benefit versus face amount. Face amount is what you applied for. The amount of insurance that you want to apply for at time of application. So that's in the beginning. Let's say 100,000. Death benefit, that's the amount that's going to be given to your beneficiaries. The reason why I say it's very important to differentiate these is because these amounts can be different. So the death benefit option is pretty much us asking you, upon death, Mr. Client, how would you like the benefit to be given to your beneficiaries? Do you just want the amount that you applied for? Or do you want the amount that you applied for plus the fund that you're able to accumulate given to your beneficiaries? That's why we're talking about face amount plus fund, or you can also call it increasing death benefit, or face amount only, that you can also call level death benefit. So when we have face amount plus fund, it means that that amount that you applied for, let's say $100,000, plus the amount that you were able to accumulate, $30,000, that's going to be given to your beneficiaries upon death. So in total, the beneficiaries will get $130,000. The other option, face amount only, means you apply for $100,000 at time of application. Upon death, the beneficiaries will only get $100,000. That's the type of death benefit that we have. So to explain them further, here is a little bit of picture. I think this can explain exactly how it works. So this is the face amount plus fund, which I think is a very popular option as well. 1 second. I'm looking at the chat at the Q&A at the same time. And I'm going to insert this after with level cost of insurance, what will happen to the cash value. All right, so, and that brings me back to what I just said. It's very important to differentiate death benefit versus face amount and premium versus cost of insurance. Now let's explain death benefit, face amount plus fund first. I gave an example and I said, if I apply for 100,000, I'm gonna have that as my face amount. That is my face amount. That's the amount that I applied for at time of application. I decide that upon death, I want to give my beneficiaries not only the amount that I applied for, but also the amount that I was able to accumulate over the years. Let's say when I pass away, I was able to accumulate $30,000. That means that my beneficiaries are going to receive $130,000. So it's gonna have the insurance portion plus the savings portion. This is more for a client with a growing insurance need. That would be perfect for them. Now, on the other side, we have face amount only. The question I got in the chat, I don't know if you meant level death benefit or really level cost of insurance. But if it's the level death benefit, the accumulation fund is actually still there. Because the question was, what happens to the accumulation fund? So when I have universal life, and I mentioned this at the very beginning of this presentation, I said, always remember, we always have two components when it comes to universal life. First one is insurance, the second one is savings. So that means that it doesn't matter what type of death benefit I choose, what type of cost of insurance I choose, as long as I hear universal life, I always have insurance and savings, or if you want to call it face amount and accumulation fund. So what happens to the accumulation fund when I only want face amount as my death benefit option? Death benefit face amount only also means level death benefit. The $100,000, if I take the same exact example, that $100,000 over the years is going to be reduced by the accumulation fund that I'm like accumulate. When you complete an application for UL, you're always going to notice you have to enter at least two categories of beneficiaries. The first one is the insurance beneficiary. The second one is the accumulation fund beneficiary. That's because these are two different components. So if I apply for $100,000 and I decide to do face amount only as my type of death benefit, I'm telling IE that upon death, just give my beneficiaries a total of 100,000. Let's say when I pass away, again, I'm able to accumulate $30,000. But I told IE that I wanted to give 100,000 to my beneficiaries. So what's going to happen is my beneficiary that I added to be my accumulation fund beneficiary is going to receive $30,000. In total, I want all my beneficiaries to get 100,000. So that means I have the difference, $70,000. That's going to be given to the insurance beneficiary. That's why we still have those two components as long as it's a UL, and that's where the accumulation fund goes. Is it accessible? Absolutely. And that's what makes a difference between universal life and if you had a traditional life insurance, where if you apply for 100,000, for example, and it's a T100 is very traditional. All you have to do is pay the premiums. Upon death of the insured, beneficiaries are getting 100,000. So you're probably wondering, it's the same thing with face amount only. It is the same thing. The only difference is we do have accumulation fund inside the UL, and that's giving you some flexibility. So that is the difference between both. I'm just gonna go look at the chat as well. What do I mean? The fund's beneficiary. So the accumulation fund is always going to be part of universal life. It could be zero. If you don't overfund your policy, your accumulation fund is always going to be zero. If you overfund your policy, then you're going to have some accumulation fund. So that accumulation fund is going to have its own beneficiary, and it can actually be the same person. The beneficiary for the accumulation fund can also be the beneficiary for the insurance component, but you have to indicate both always. It could be different individuals, it could be the same individuals, then you have to indicate them. It's going to be separated. When you complete a universal life application, you will see that it's not just going to ask you for one category of beneficiary, it's going to ask you for two different types. So one is for the insurance and the other one is for the accumulation fund. Another question here is, does it mean the premium for level is lower than face amount plus fund? Okay, when you say level, are you talking about the level cost of insurance? Are you talking about the level death benefit? Because I know I is not the only provider that gives universal life, so I know there's different ways to call all of these different options. So it's very important to differentiate them, but also in order to really answer this, I think I need, okay, I'll get the answer. Level death benefit. Does it mean the level death benefit is going to have lower cost of insurance? Yes. It's pretty much going to give you a lower cost of insurance. In the beginning, if you do warranty, because face amount only comes with warranty cost. There's no level cost available. If you want to do level cost, you have to do face amount plus fund. So if you want to compare apple to apple, I would say you can compare warranty cost with face amount only and warranty cost with face amount plus fund. In the beginning, you're going to see the cost of insurance for both. It's going to be the same. So the starting cost of insurance is going to be the same. It's the same warranty cost. But next year and in the future, you're going to have a higher cost of insurance if you're deciding to go for face amount plus fund versus if you're going for face amount only. The face amount only has a more minimized cost of insurance. It is still going to be warranty, as in you're going to have that increasing cost of insurance, but it's not going to be as high as if you chose face amount plus fund. I hope that answers the question. Okay, I don't have any more question about that, so I'm going to take that as a yes. And that's the difference between the face amount only and face amount plus fund. Now, in terms of premium, like I said, very important as well to differentiate what is cost of insurance or what is premium. That's because you're going to have different type of premiums in a UL. So the cost of insurance, which is pretty much going to be your minimum premium. Your premium deposit, that is your choice. That's the amount that you decide to pay. That's the amount that you decide that you're going to pay this so that you have some excess amount that you can put inside the accumulation fund. And pretty much, as long as your premium covers the cost of insurance, your policy can stay in force. Doesn't mean that you just need to pay the cost of insurance. I will not recommend that, because you don't take advantage of the great features of a UL if you're just paying the cost of insurance. You pretty much are not overfunding the policy. So as an example, let's say the cost of insurance is $7. You want to overfund your policy, you can pay $10 if you want. That $3, that excess amount, is going to go to the savings component, and it's going to grow over the years. So it's going to keep accumulating. That's why this is great for the flexibility. Now, on the illustration or the contract, you're going to find different terminologies when it comes to premium. So you have the minimum premium. Like I said, that is the required amount to keep the policy in force, which is pretty much the cost of insurance. Then you have the target premium. Target premium can also be called premium deposit. That's the amount that you decide to pay. So based on the example that I gave, let's say $10, that could be a target premium. Especially if you decide to pay quickly, you want to pay the universal life quicker. That means that you want to pay something that's going to be in force permanently. You want to pay that in a short amount of time. Of course, you're going to have to overfund the policy even more. Reference premium is just a recommended premium to cover the cost of insurance. However, it does not guarantee that that's going to cover all the cost of insurance until they are all paid up. And the last one, it's maximum premium. The um, maximum premium is, I would say this is just us guiding you to keep this policy tax-free as much as possible. The purpose of a UL is not only gives you that flexibility, but also we want to minimize taxation as much as possible. The tax-free death benefits, that's a great incentive. We want to keep everything tax-free as much as we can. We already have so many accounts out there that's always going to be taxed. Whenever we have too much money somewhere, it's going to be taxed. And it's the same thing with universal life. It's the government still controls what's going to stay tax-free inside the UL. The same way they're saying that if you exceed this amount of contribution in your RSP or ESP TFSs, then we can ask you for more money, also known as taxes. So we want to make sure that you don't exceed the amount. How universal life works is when you put money inside the policy, that policy is going to have some accumulation fund that will give you the surrender value, the cash surrender value, it's cash value. So that cash value will have a certain maximum that's going to be allowed to stay tax-free. And if that maximum is exceeded, then we're going to have to move that money, the excess amount, into an account that's called shuttle account or shuttle fund. A shuttle account is what's going to be taxed. You're going to have to pay tax on that. So that's why we're giving you a maximum premium to guide you that do not exceed this amount. Of course, if you have a client that's going to say, hey, I have $50,000. I want to put all of that money inside the UL and I don't want to think about it again because I just don't want to think about it in the future. But can that be possible? Technically, yes. They probably have a lot of funds that can cover the future cost of insurance, but for tax purposes, it's not going to be advantageous because they will have to pay a high amount of tax on that excess amount because that's going to generate a really high cash surrender value, and it's going to exceed the maximum allowed by the Income Tax Act. And at that time, we're going to have to move some of that money into the shuttle account, which is going to be taxed. So that's why we have the maximum premium as your guide. And we have so many investment options available for you. I want to go over all of that today. I already explained about the SRDA. This is a way for a client with a more prudent risk profile, I would say, to get the universal life plan and still make them comfortable with the accounts that's going to be chosen. So you can choose the SRDA, and it doesn't have to be 100% SRDA. You can choose different allocations if you want. Like our in say all the time, they say don't put all your eggs in one basket. So you can absolutely do a mix and match. Now let's take it to this Evo. I was gonna say software, but it's not on the software anymore. Let's do Evo, a quick demo. I'm gonna go under create an illustration, universal life. So you can see here the top cost type of insurance available. So we have warranty, level with quick pay options. I'm going to just pick one first because I can always change it once I'm on the illustration page anyway. What I'm going to do today is I'm going to change my client's age first. Let's do 35. Actually, I didn't need to do this. Let's just do 35. And I can leave my face amount at 250,000. And I'm going to do face amount plus fund. The reason being is because if I do face amount only, I have warranty cost type of insurance only available. I don't have both warranty and level. So I need to choose face amount plus fund in order to have both options. And that's because I want to show you the difference. And I also want to show you that every time you change one item, the entire result can be different. So I would say with Universal Life, you can feel free to run different illustrations, scenarios, run different comparison. And don't only look at the premium, because I know we always look for what's the most available premium that the client could pay for a very generous coverage. We always want that. But in this case, I want to show you that there are different factors inside the UL that can affect the entire result. So it's very important to make sure that we educate the families about that. Okay, I'm just gonna quickly answer one question in the chat. Does it mean that once I pay the maximum premium, I won't have any tax payment? So the maximum premium, which is right here, as you can see on the screen, it's 820. This is only based on this projection, meaning if my funds are performing at 4%, this would be the maximum premium, because we don't know how these are going to be performing in the future. So it's going to be most likely with Universal Life, the numbers that you're going to see are going to be just for illustration purposes, and it's going to be a projection, unless it's the cost of insurance. The cost of insurance is what's going to be guaranteed. Minimum premium, this is for sure, it's going to be the cost of insurance. That's going to be the only thing that we can guarantee for this particular situation. But other than that, it's going to be a projection, unless you also go for the face amount plus fund with level quick pay option, the guaranteed quick pay option. But I'll talk about that. Don't worry. Okay, so I'm going to leave my face amount at 250. If I talk to this client, let's say my client is called John Smith. Okay, Mr. John Smith, here is an illustration for you. I'm gonna, let's say, change my interest rate at 5%. By default, our platform gives you a 4% interest rate, but you can absolutely choose different ones. Depends on how you want to illustrate this for your client. I'm gonna do 5% for this one. Okay, so let's say based on this scenario, 35 male non-smoker, I can show this to my client. Okay, Mr. John Smith, this is your minimum premium, $37. Reference, which is again just a suggested amount, 114, maximum 820. You can personalize how much you're paying. You don't have to pay the $37. So if you want to personalize it, you can click on modify and you can enter the amount according to your preference. Now, I'm just going to show another one for my client, because let's say my client heard about different cost of insurance. There you go. Okay, so now with this level option, I see 153. Reference is going to be the same, because the reference again is the amount that we suggest or we recommend to keep the policy in force, to cover the cost of insurance in the future. And then we have the maximum premium here, and you can always personalize it. If I show this to my 35-year-old male non-smoker client, he's probably going to say, I want to go for the warranty one. Are you really telling me that as long as I pay $37, I can get this policy? The answer to this question is actually yes. If he pays $37, we can put this policy in force. But just wait 1 second. Let's say I'm going to show this client. Sure, we can pay $37 here. I'm not even going to do any quick payment yet. I'm just going to show you how much I'm paying, and can this be in force? And the most important question as well would be, can this stay in force? So $37, good. We can have the policy in force, but only for 1 year. That's because I selected warranty cost of insurance. Policy will lapse because the premium payment that I'm putting inside this policy is not going to be enough to cover the future cost of insurance. So that $37, yes, we could put the policy in force, but we cannot keep the policy in force for longer than 1 year. Now, let's say this client says, okay, so let's try level cost of insurance then. So we saw that the minimum premium for level cost of insurance here is $153. So I still want to specify. Let's say I just want to pay the minimum as much as possible. So it was 153.75. I'm going to click on apply. And now let's look at the result. And here, this is really me showing you that yes, the minimum premium reference maximum, these are important things to look at. However, it's very important to also look at the results. So the first thing that I'm not seeing here is the message that says the policy will lapse. So that's good news. But when we think about it, we're talking about a universal life product. Universal life was designed to give you not only the security of a life insurance, but also the flexibility of the cash value. So accumulation fund, do we have any here? None. It's zero because we're not overfunding the policy. We're just paying the minimum, which is enough to cover the cost of insurance, but it's not making us take advantage of the great features of the UL. So it's good and bad news. Let's go back to coverage. And let's say I keep talking to this client, and I could say, Mr. Client, if you're willing to pay 153.75, let's take the same amount and just, let's say, take YRT cost of insurance instead. It doesn't have to be 153. It could be overfunded differently, but I'm just showing you that the client's budget also really matters in this case. So I'm gonna take the 153 here. It could also be the reference premium if you want. You can pay higher than the reference. We have different options here. So you can specify it, or you can pay 120% times the reference, or you can do a quick payment, which I'll show after, but you can absolutely customize it according to the client's budget, preferences, their needs, and so forth. So based on this particular client budget, and now that we switched from level to YRT, I can not only see that the policy stays in force, but also see that we do have some accumulation fund. That's because we decided to overfund the policy. We're paying more than the minimum premium. That $37 premium cost of insurance, sorry, that $37 is not going to stay the same next year, but at least we have enough accumulation fund that can help us cover any future cost of insurance. And whenever the client passes away, any amount that's going to be in their accumulation fund plus the amount that they applied for is going to go to their beneficiary at that time. It makes a big difference. If I decide to change the interest rate, you're going to have different results as well. So that's why I say this is a projection. It's very important to make the client understand that it's going to be a projection. I cannot promise that this is going to perform at 5%. If it doesn't perform at that performance, the first person that's going to get a call from the client is the advisor. So let's make sure that they understand how this works. We're here to educate them. How we can add investment portfolio. Okay, so if it's a new policy, you can add it under investment right here. And you can add an investment instruction right here. As long as the allocation equals 100%. In total, you can choose different fund. If it is for an enforced policy, you can do the e-change. So the e-change will be under homepage, and there is sorry, I don't want to go back there right now, but just to explain you can just go back to the homepage, and then once you're there, there is going to be a button on the right hand side, right top corner. It's going to say make any change, so you can do the e-change to change the investment instruction of a policy from there. Okay, the other things that I want to show you will be the quick payment. So in terms of quick payment, you can do, I will say, I'm going to call it regular quick payment and the guaranteed quick payment. You can do regular quick payment with any cost type of insurance, whether that's YRT or level cost, you can do the quick payment because nobody wants to actually pay a policy up until age 90 or age 100, depending on the cost type of insurance that you decide to go for. Again, warranty cost is paid up to age 90. Level cost, the regular option, is paid up to age 100. But if you want to do a quick payment, you can do the regular quick payment. To compare the regular quick payment options that we have, I'm going to pick level because that one will give you the regular quick payment, which is, if I click on modify, I'm going to select the type of premium deposit and I will say quick payment right here. And I'm going to pay this, let's say, in 20 years. Click on tab, calculate. This is the regular quick payment. And why I keep saying that is because this is going to depend on how your funds will be performing. The regular quick payment means that your level cost of insurance is still going to be paid up at age 100. Or if it's warranty cost, then it's paid up at age 90. That cost of insurance, those costs of insurance only stop after age 100 or 90, depending on which one you go for. However, if I pay $222 per month, I might be able to pay this in 20 years if my funds are performing at, again, 5%. And that's why this really depends on the market. This is just a projection. If I change this and do 6%, I'm going to have a different amount. Just as an example, let's say 6%. This is going to calculate a different amount for me. So quick payment, calculate again. I had $222 per month earlier. Now I just need to pay $207. That's because it tells me that if my funds are performing better, so 1% better than the 5% that I did earlier, I just need to pay $207 per month in order to cover the cost of insurance in the future in only 20 years. But that's only a projection. So that's why we have that. And same thing, if I change this to 4% and I do modify it, that means that my funds are not going to be performing as much. So I can do the same thing, calculate. You're going to have a different result based on your projection. Now I have to pay $241. So let's say click on apply. That's the regular quick payment option. The other option is the guaranteed paid up. So that's going to be available under level cost of insurance, guaranteed paid up option. And if I want to compare apple to apple, I'm going to say 20-year quick pay. So the 20-year quick pay means the guaranteed quick pay means that after 20 years, there's no more cost of insurance. Again, the regular quick pay option is level, it's going to be paid up to age 100. The guaranteed quick pay option means that the cost of insurance will be paid up either in 10 years, 15 years, or 20 years. Even if the market crashes, as long as I pay $277, that's the minimum premium, my policy can stay in force for life. And that's why this is something that can be great even for children. They're younger, have a much lower cost of insurance at that time. You can secure their insurability. You pay this policy for 20 years only. And once they're adults, they can actually have this policy for life. They don't have to worry about any future cost of insurance anymore. And it's going to be up to you and your client at that time to discuss about whether it's going to be worth it or not to pay that extra dollar per month, those extra dollars per month, just to have the guaranteed feature. And it all depends on how you want to illustrate this plan. All projection. I hope that helped, and we're also at the end of the hour. Thank you so much, everyone, for attending. If you would like to have a chance to listen to the same presentation again, we have a repeat session on Thursday, same time, 10:30 a.m. I would strongly invite you to join again or invite your team members, especially if they're newly licensed. I think these are a great way to educate themselves in order to help educating more families out there, because we do have some great solutions that are available that's worth talking about. So thank you so much, everyone. Have a wonderful week.